Hello everyone, welcome to Optiongig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. Today I'll try to answer a question that was asked to me by one of my students is, do we have option trades that are specific to earnings season? So earnings comes 4 times a year. Are there some trades that we as an option trader can do during that earnings period? So we'll address this question through this webinar. Okay, now look at what happens during the earnings trade. So on the day of earnings announcement or up to the day of earnings announcement, run up to the day of earnings announcement, the implied volatility of the particular stock goes really high. It stays relatively high as compared to the other days. Why? Because the earnings announcement creates uncertainty in minds of traders. They really do not know how the earnings are going to be. Is it going to be good or bad? So that uncertainty leads to high volatility in the stock. Now, question is, can we use this high volatility to our advantage as an option premium seller? So let's see what kind of a trades we can do. The earnings time is a great time to reduce the cost basis. For example, if you wanted to acquire a shares at today's market price before earnings, then you could actually go and sell a put just right before the earnings, because you will receive a very high premium for selling the put. So in case if your option expire in the money, you will own the shares, but you would have reduced your cost basis by the amount of premium that you have taken by selling the put. Or if you already own the shares, you could sell the call against those shares. You could have a covered call trade. Doing a covered call trade just before earnings fetches you a lot more premium because of the elevated IV than doing a covered call outside of the earnings. But what if you do not want to do any trades that have to do anything with the stock? That is, you do not want to sell a put to acquire the stock, or you do not have a stocks against which you want to sell a covered call. Is there a pure play option trade possible during the earnings season? To come to that conclusion, let's first look at how the implied volatility changes in run up to the earning and immediately after the earnings announcement. So here's a live example of TripAdvisor, and as you can see in the graph, there have been multiple earnings announcement in TripAdvisor. There is an earnings announcement over here, another earnings announcement over here, another one over here, and the most recent one over here. As you can see, in run up to the earnings, the implied volatility has reached to the almost the highest level of recent times in all the cases. In this case, again in this case here, again in this case here, again in this case here. But interesting to note is what happens immediately after earnings. As you can see, immediately after earnings, the implied volatility has dropped like a rock. Same here, drop like a rock, same here, drop like a rock. So this particular behavior of implied volatility getting high and then dropping like a rock does present us with some opportunities for pure play option trades. Implied volatility does not tell us whether the stock is going to go high or low. In all these earnings announcements, the stock has behaved differently. Here the stock popped up after the earnings, here the stock went down after the earnings, here's popped up after the earnings, here it went down after the earnings. But in all the four cases, the implied volatility always go down. It falls like a rock. Now this particular behavior of implied volatility going high up to the earnings and then falling like a rock immediately after earnings does present us some opportunities to sell option premium just outside the expected move of the stock. So on your broker platform, you can find what is the expected move of the particular stock during the earnings. And this expected move could be in either direction, either up or down. And we know that the expected move or the volatility in the stock is always overstated. So the trade that we can do to take advantage of that overstated IV and the overstated expected move is to go and sell the premium so that the break even is just outside the expected move in upward direction as well as in downward direction. For example, if the stock is currently traded at 100 and the expected move is 5, then you could go and sell a short call and a short put and collect enough premium so that your break even is beyond 105 on the call side and less than 95 on the put side. Earning trades should be very small percent of overall trades. There is no real edge. So it should not be a primary method to build income through options trading. This is one of the mistake I have seen many newbie option traders do is just before earnings, they'll buy a lot of calls and maybe one of the calls work in their favor and then they think they have discovered the magic formula to make money using option trades during earning season. No, that's a false positive. So earning season should not be a primary method to build income through options trading. Earnings periods should be used to stay engaged in market. So now the question is, if earning trades do have a place in our portfolio, are there any specific rules that we should observe when opening an earnings trade? Now, as per to the time of opening trade, try to open it as close as possible near the end of the previous trading session. Example, if a company is announcing earning on Thursday morning, try to do the earnings trade on Wednesday before the close of trading session. Since the IV is high, you would want to wait until the last moment to capture all the stock movement before you place your earnings trade. Remember, like I said, there is not much. It's a 50-50 shot. So you want to make sure that stock has done all the movements that it could do before you get into an earnings trade. Ideal time I have seen is last 1 hour before the market closes. By that time, all the movement has already been factored into the stock and only thing you're playing is a elevated IV. Now when to close an earnings trade? As soon as the IV drops when the next trading session opens after the earnings announcement is done. As an option seller, our edge was elevated implied volatility. So once the implied volatility has dropped, there's no point in staying in the trade. So we should get out of the trade once the IV has dropped. Whether profit or loss, we should close the trade. Generally, I have seen the ideal time to get out of the trade is within 30 to 45 minutes of the market opening after the earnings announcement has been done. Alright, takeaways. Earnings trade have a place in the portfolio, but a very small as compared to the overall trades. Like I mentioned earlier, it's a 50-50 chance. So it should not be a primary method of income generation. It should be a tool for staying engaged in the market. Now, to do earnings trade, you should choose only high IV and highly liquid underlyings. And when to place an earning trade is just get in just before the last trading window closes, and you should get out as soon as the IV has dropped, ideally within the first 30 to 45 minutes of the trading window opening after the earnings announcement has happened. Take whatever profits you are available. There is no specific profit target for earnings trade. So take your profit and move on. I hope this is helpful to you. As always, if you have any questions, please write it in the comments or email it to optiongig@gmail.com. If you liked what you learned, please help us spread the word so others can also benefit from it. Thank you very much.